So that's the view coming in at the index level. The big movers today, of course, Zee Entertainment and ICICI Bank. So let me take it across to Nuresh to get his view on both those counters. At what level Zee becomes a buy, Nuresh, and ICICI Bank, is it the start of the rally? And if yes, what are the levels to watch out for on the upside?
So starting with ICICI Bank, the stock last had made a top around 1,000, gave a breakout, and we did not see a strong follow-up, but we kept on holding to the 980 mark. Now, crossing the all-time highs of 1,050 indicates a fresh start. Minimum target price would be 1150, 1200 in the short to medium term. So remains a buy on dips and a buy even at current levels that open and accumulate through the day. Going into Zee, say if one is looking out for say a gutsy trade that comes to that 180, 190 mark, because that is where it all started from. So if you go back all the way 2 years roughly, the price before the big announcement, the stock was around closer to 190 to 200, 188, 190. So at 180, 190 zones, it implies the whole, say the saga is back to the same place. So if you want to look at it as a risk reward buy, 180, 190 would be the buy.
Kunal, at some point, do you expect some sort of short covering or something to happen on Zee Entertainment? Today is going to be a complete down and out day. And for cipla as well, do you think it is one of the strongest charts in the pharma sector?
Yeah, I think cipla is now emerging as the strongest chart. Lupin is also one of the other stocks which has done reasonably well in the last 6 months, 12 months kind of a time frame. In terms of Zee, I believe that today may not be the day where you'll see a short covering. I think today is a day where you'll see a lot of positions being unwound into the stock. So the concern is that the stock is already in the F&O ban. I think it was still in the F&O ban on Saturday's closing also. So that generally indicates that you may not see a fresh shorting which could emerge into Zee. But then on the cash side, there should be a significant unwinding which happens. And hopefully by the end of the expiry week, if we see the stock coming back out of the F&O ban, then we may actually see one more round of shorting which can happen into the F&O side as well. So the pressure would keep on mounting on the stock over the next subsequent 3-4 days.
Yeah, sorry, I misspoke. I didn't mean short covering. I meant fresh shorts in the system
or
long unwinding.
Yes. Yeah, absolutely, because it seems like there's going to be quite a bit of damage in the stock all through the course of the next 2 trading sessions as well, despite, of course, the carnage that's going to play out today. And Kunal, you said it's in an F&O ban, right? So once it's out of it, that's when the true poison is going to come out of the system, I guess.
Exactly. So the true value of the stock would generally be found post, once it comes out of the F&O ban.
Yeah, absolutely. So yeah, it's as worse as it can get today for Zee. It's gapped down already, 10%. Some of the solo stocks that Anisha flagged off earlier today, your Sterling and Wilson, Tata Power, all those are the ones which are, seeing quite a bit of green. The Prime Minister, remember, has announced a rooftop scheme for 1 crore houses. So most of these names are holding out very well. But I think the star today and the savior today is going to be ICICI Bank alone. 5.5% is the kind of move that the pre-open rate itself is throwing up for ICICI Bank. Clearly, you saw the ADR as well jump overnight. Q3 performance has managed to beat the estimates. So that's going to be finally the one perhaps which is going to lift the soured sentiment within the banks, which got created by HDFC Bank last week. 0.7% higher. We've made it back to 21,700 on the Nifty. 0.6% of a move coming in for Sensex. Now we've jumped up 500 points as well. I want to first see what ICICI Bank is doing. It's at 1,044. That's a move of 3.5%, which is coming in an ICICI Bank. And I guess that would rub off on the rest of the banking pack too. Let's see whether HDFC Bank in the interim has bottomed out, or is there more pain left in the system for HDFC Bank? Still soured, still down 0.5%. A gap down move, no less, for Zee Entertainment. That's exactly, on expected lines. It started off lower by about 10%, but have to admit that it's actually only ICICI Bank solo, because I can see a very flat move even on Kotak. Remember, part of the trade already played out on Saturday, given that was a full trading a day and the numbers came out well within market hours, but you're not really seeing any follow-through price action on Kotak. So it's single-handedly ICICI Bank alone all the way, and that too has fizzled off a little bit from that gap up start. It's now up about 3%, but that in itself is a good move regardless. You can see Tata Power, etc., hold out well after that Prime Minister, policy announcement of rooftop schemes. There's persistent, very good Q3, robust deal wins. Remember, this was one of the big IT outperformers all through 2023, and persistent, no relenting there, still holding up almost 4% as we speak right now. Cipla as well. You know, there's been a margin upgrade which has come in. Q3 has been a beat. It's a 6.25% gap up start that you're seeing on Cipla. Z continues to sulk, and I want to see what IDFC Bank as well is up to. After those numbers didn't quite match up with what the street was anticipating, IDFC First Bank down 5% as we speak right now. Some of the other names which are going to be in focus today, Tata Motors after that PV price hike. There's Colgate as well, which has come out with its numbers. There's Coforge, wherein the constant currency revenue growth has come in above estimates. There's Canfin Homes. NIMs have seen an improvement quite sharp on a sequential basis. So these are some of the stocks. Transformers, rectifiers. There's Keystone Realtors. We were just chatting with them. They've signed a letter of intent for redevelopment projects worth GDV of about almost 1,200 crore rupees. Keystone as well gaps up 2.5% as we speak right now in trade. Anisha, anything that you're spotting?
Yeah, Kunal's pick Petronet has actually opened up quite well, 5% higher, and of course this entire ecosystem of solar names. So Borosil Renewable is the one that is there on my radar, a 17% surge, and Borosil Renewables at that is up a solid 18%. You also have, of course, Cipla, which is perking up as we speak, and the railway stocks, there's no stopping them. IRFC is up another 9% today. RVNL has surged quite a bit. Max Health is the other one that I'm watching out for. That's also managed to open with a gain of around 5%, and Karur Vysya Bank, on account of the earnings, is holding up with a 4% gain. But let's take the first trades with our technical experts. Kunal, what's the first trade that you're spotting?
So that would be on NMDC. That's a stock which on Saturday's trading session came back towards 210, 212 breakout mode. So that's a stock which I would be keen to buying, specifically looking at the recent momentum for the stock.
Naresh, let's get in a sense as to what exactly is looking good on the screens according to you today.
So, good take across the board. The stock I would be looking out for is Care Ratings, which has given a fresh breakout on Saturday. So, expecting follow-up price action over the next few sessions.
Okay, let's welcome on board Gautam Shah then and figure out what the market is going to chart as its next course. Gautam, hi, good morning. Good to have you on the show as always. Gautam, before the index, I want to talk about what's happening within the Nifty Bank because that's dictating how the index has been moving off late. Is the poison out of the system for HDFC Bank? It doesn't seem to be the case because right now the stock is lower by another 0.5%. And B, can ICICI Bank take leadership now on the Nifty Bank?
Good morning, Aisha. Well, the Bank Nifty does not feel like an index. The problem is 4 stocks constitute for 50-60% of the index. So if those 4 stocks do well, the Bank Nifty does well. And if those 4 stocks come under pressure, obviously the Bank Nifty comes under sizable pressure. And we saw that in the recent past, given what happened to HDFC Bank. But to be honest, for the last 2.5 years, the stock has been in a broad range. 1450 area on the downside, 1700 area on the upside. It's actually been a no-brainer underperformer all along. And there's no point living in hope unless the price action itself gives you the indication that things are changing. So I think if you really look at the ratio chart of HDFC Bank divided by the Nifty, you will see that for the last 3 years, it's been downward sloping. So there was never a reason to commit big in that stock, even though it might have been fundamentally super strong. We remain of the view that somewhere around 1450, there could be solid demand coming in. So the chances of some pullback from these levels are pretty high. And I think we also saw a bit of a selling climax in the recent past because there has been so much talk around it, and people are actually wanting the stock to do well. But any which way, I think banks in general look good. 45,500 on the Bank Nifty is an excellent support. We rebounded from there. And I think the chances of a bigger turnaround in banks in general, maybe X of HDFC Bank is pretty high and SBI remains our high conviction idea. So there is upside in the banks, but I don't think it's going to be a big contributor to the Nifty move from here.
You did say that SBI could be one of those special stocks when we spoke with you last time, that it could do special things in 2024. So we are watching out for that one. But the other space which is seeing quite a bit of action is pharma, right? And you also talk about how there's a rebound possibly in the offering there. Which are the top, stocks there that look interesting?
See, when you are at levels close to 22,000, I think risk reward plays a very important role in what you do at the markets. And I think at current levels, pharma offers a lot of value. We've seen some lovely trends shape up in the recent past. I mean, look at what Sun Pharma has done. It's just been a nice, clean, steady move up all along. Doesn't have anything to do what the market does. And I think these are the kind of trends that you want to commit yourself in. So pharma, I think as an index continues to look super solid. And I do see another 10% upside for the index. So stocks could give you anywhere between 13 to 20%. Within the pharma space, Sun Pharma, Dr. Reddy's, Divi's Lab, and Cipla, which came out with results and it's reacting today, all look super solid on the charts. And I still believe that at these levels also for the market, one should commit into pharma because I think this is a trend that is going to continue for the next couple of quarters. So pharma and IT are actually our favorites in the current market from a risk reward angle.
In IT, then, if we were to get stock specific, given that you're talking about it being an outperformer?
Well, yeah, I think our working target for the IT index has been about 39,000. So I think we will get there gradually. Midcap IT has already seen a very smart move in the recent past and continues to run up. I mean, look at stocks like Persistent, Mastech, LTTS, Coforge, Emphasis. All of these stocks, I feel, have the potential to go up another 10 to 20%, maybe even more if you have a slightly longer term time frame. And if you look at the large cap IT stocks, I think the kind of rebound that we saw post Infosys results, I think that's just changed the game to some sense. I think smart money is trying to get in there. Institutions are far more convinced about buying into IT. And it is probably one of the few indices in the market to be far away from lifetime highs. So I think it offers great value even at these prices. It's not overbought, it's not overly valued, and I think there is some sense of the earnings in the next couple of quarters. So I think all the top stocks, with TCS being our favorite, followed by HCL Tech, Infosys, Tech Mahindra, and then Wipro.
Gautam, have to shift stance to what's happening within the broader markets, right? And railways, look at the kind of move that you've seen in this entire sector just last week alone. I mean, we were just looking at the valuations of an RVNL, IRFC, IRCON, etc. Any of these names that you track, and do you really think the momentum is going to sustain?
We were very bullish on it all along because I thought that the breakouts were very clean. And remember, these are stocks, so this is a theme that broke out after doing nothing for about 5 to 6 years. So it's understandable that it's seen such a rally. But now the rally has become parabolic. I think it's beyond fundamentals and it's beyond technicals. So these are levels where one can easily take profits. In fact, we have been recommending to take profits in the recent past. And I think the rally is a little overdone. You might miss the last phase of the rally, which is okay. But I think the risks of holding railway stocks or adding railway stocks at these levels is pretty high. Yes, it might be a 3-year theme, 5-year theme, but somebody who's looking at 3 to 6 months, I don't think these are levels where you can commit. So take profits, move to other spaces in the market. There are newer sectors, newer themes which are, coming out of hibernation, and you rather concentrate on them.
Let's have that list then, Gautam. What is it that you see coming out of hibernation, and where is it that we can put fresh money to work?
I think metals have started to look quite interesting. So we've been watching many of the top metal stocks very closely. I mean, look at a Nalco. I feel it's a very high conviction idea for us for the whole of 2024. I think it can deliver supernormal returns. Steel Authority of India, Tata Steel, JSW Steel. I feel that all of these stocks, maybe they might not mirror the move of railway, but definitely, it's going to beat the Nifty returns for sure for the next 2 to 3 quarters. Auto ancillary, I think, is a very interesting space that we like. Fertilizer, I think, is a space that we like. Paper stocks, we just recommended JK Paper a few days back. That's a space that we like. And that entire unlock theme, which is airlines, hotels, I think this is a big theme that's going to continue in play. So if you look at Indigo, you look at, some of the other Indian hotels, Lemon Tree, and some of the other unlock theme stocks like Sapphire Foods, Devyani International. I feel these are stocks, which are very good on fundamentals and haven't done as well as some of the other themes in the market. So they should do quite well.
Let's talk about the frontline index itself, Gautam. As far as the Nifty is concerned, where do you see that one headed? Because for the interim, people believe that we have already made a bit of a top for the at least next 5 to 6 months. Would you concur with the view? Or are you expecting a pre-budget and a pre-election rally as well?
Well, 5-6 months is too long to look into the future because, these days the world changes in about a quarter. Recent highs are just 3% away. So I don't think I'm in a position to say that we topped out. But I do believe that 22,200, 300 is an important resistance. It might not get taken out in a hurry. It might maybe take a few weeks. And on the downside, the 21,300 area is an important support. And after the kind of rally that you saw in November and December, if the Nifty just stays in this band for another few weeks, maybe until the budget or just slightly post the budget, that's actually the best case scenario, because you want bull markets to go through consolidations, rotational corrections, which is what we've seen in the recent past. So I'm actually very happy if the Nifty is boring, because there are much better opportunities outside of the Nifty. Look at the Nifty Next 50 index. Obviously, the mid caps and small cap space, which continues to buzz despite all the overbought signs on the charts.
Okay, and what about the metal sector as a whole, Gautam? Is that something that you would be avoiding or looking at selectively? And if so, which stocks?
So I just spoke about metals, and I mentioned that it's probably one of our high conviction ideas for the rest of this year. Looks very good on the charts. It's coming out of many months of consolidation and underperformance, and now a lot of setups collectively have done well and looking good for more. So Nalco, Steel Authority, Tata Steel, JSW Steel on top of our list, and I expect all of these stocks to deliver supernormal returns this year.
What's the view on Reliance Industries as well as L&T?
See, L&T has been my favorite all along. I think every time I've been on your channel in the last couple of years, the one large cap high conviction idea that we've shared all along was L&T. At these levels, you cannot commit fresh, because I think a lot of positives are in the price. But I think Reliance has come to a point where it can actually start to support the index. For the last 1.5 years, it was the problem for the index. Now it could actually support it. And this breakout that took place in the recent past looks genuine. And I do believe that this attempt should take Reliance to that number of 3,000, which it's not been able to do for a very long time. And 2550, 2600 now becomes a solid base. So IT and Reliance put together, these two baskets put together should keep the market safe. And that gives me the confidence.
Gautam, you highlighted your views on the Nifty, but do you think this outperformance at large from the mid and the small cap index vis-a-vis what the Nifty does, would that continue?
I think it's going to continue, Aisha, and the best way to understand that is through ratio charts. So if you simply did a mid cap index divided by the Nifty or the small cap index divided by the Nifty, you'll see that they are in mega uptrends, and this is not going to end anytime soon. Also, one cannot compare what's happening today in the broader markets to anything that's happened in the last 25 years. When have you heard 7,500 crores coming into the broader markets, mid caps and small caps, every single month from the domestic liquidity side? This has never happened in the history of Indian markets. That's probably the reason the framework has changed, markets have evolved, and I think quality stocks in mid caps and small caps will continue to be rewarded. Grade C and grade D, you need to be very careful because everything is moving at the same time. But if you stick to grade A and B in mid caps and small caps, you will still be rewarded even at these levels.
You flagged off railways. What are the other spaces where you think there's the amber light and the warning signal and one needs to either avoid or at least profit take?
See, I think there's no red flags or warning signals as such, because many of these are structural stories. But there has to be a point where you have to take a call to take profits. I think that's a call that we are taking in railway stocks. That's a call that we are taking in real estate. We've been very bullish on it for the last couple of years. I think from a near-term perspective, it's a little overdone. So real estate, select auto stocks, if you look at capital goods, I think that's also had a wonderful run up in the last 2.5 years. That's also looking quite overbought. So stay away from these segments and look to commit in IT, pharma, metals, select banks and select chemical stocks.
Point taken. Gautam, on that note, we let you go. Thanks so much for making time and speaking with us. So at least on the charts, it seems like some of the railway stocks do deserve some profit booking, but let's take it across to the industry expert to get a sense as to what's changed in the entire sector that warrants that big rally that we have seen over the course of last 1 year, 1 month as well. Umesh Chaudhary, the Vice Chairman and Managing Director at Titagarh Rail Systems, joins us on the show. Umesh, hi, good to be speaking with you. That's exactly my first question. What do you think has turned in favor of the entire railway ecosystem over the last 3 to 6 months that the street is banking a lot on it?
Good morning. Always a pleasure being with you. So I think you see the railway story is a story of structural change of the country. Indian economy, in order to become a 5 trillion or a 10 trillion or a 30 trillion economy, as the Honorable Prime Minister has set up the targets, I think it is going to be an impossibility to achieve those targets unless and until the backbone of the country, which is the railway, is strengthened and is made robust. And that is the focus that has been given on the railways. And whether it's on creating new infrastructure or utilizing the existing infrastructure by way of adding on rolling stock, by way of adding on the policies that require or that facilitate increasing of traffic, etc., etc. So it's a complete transformational stage, and I must also see what has happened in the railways in the last 60, 70 years. In fact, the railways that was left to the country by the Britishers pretty much remained as almost on the same basis. It was maybe a HUF kind of a growth till this government actually started investing in the railways and transforming the railways. And in the last couple of years, 3 years, I think it's been a complete transformational story. So I personally believe that the story of the Indian Railways is just begun. And I think it is a long way to go for the railways to really reach the kind of its capacity on investments or on growth.
Thanks so much for taking time out, and I would also like to get in your thoughts on the entire Ayodhya theme and the kind of potential benefit as well for railway projects in light of Ayodhya. What kind of opportunities are you seeing in particular for the sector and for the company in specific?
See, as far as the Ayodhya thing is concerned, I mean it's a great thing for all of us as a nation, and I think as an individual, I feel extremely humbled, elated, and all the other positive emotions that can be. As far as direct impact to the railways, I don't know. I mean, whether it will be impacting the railways directly, apart from the fact that it is definitely going to add on to the tourism. And, we are manufacturing the Vande Bharat trains and all of that. So I think, that extent, the whole domestic movement, the domestic tourism, etc., would get enhanced. But there is nothing directly related to our sector as far as the temple is concerned.
Okay, fair enough. But this would also mean then there will be high competition among the rail players. So how are you looking at your overall margins, considering that there will be competitive bidding?
So competitiveness is always there, will always remain there. It's all about being ahead of the curve. You see, we've always believed at Titagar that competition is not always a bad thing. It's always, in fact, a good thing because it keeps you on your toes. We have been cost competitive in terms of whether we have two segments. We have the freight segment and the passenger segment. On both the segments, there are different set of competitors that we have. In passenger segment, we have competitors who are multinational companies. We believe we have certain advantages vis-a-vis them. On the freight side, also we are the largest manufacturer, so we have the economies of scale playing in. So based on all of that, we believe that competition is going to be there, but it's not going to be impacting our margins because it's all being more competitive than your competitor.
Chaudhary, then what are your budget expectations? Because this time the capex expenditure of the government is expected to come down. Over the last 3 years, we have seen that the capital expenditure had doubled, but this time from a double-digit growth, we're expecting it to be a single-digit. Is that something which might impair the growth or limit the growth?
So there are two aspects to this. One is that the base has become much larger. And I believe that also, when you look about capex, you cannot kind of club up everything of the capex. I believe the railways will still see growth or investments which will be unprecedented. That's my belief. And that's the reason is that today Indian economy is becoming costly because of logistics costs. people who are traveling on the trains, the aspiration of young India has changed. This is the Naya Viksit Bharat that we are talking about. So people are not happy traveling on the roof that they were used to be traveling in the past. Now they want to travel on the modern Vande Bharat. So I think that this whole paradigm shift that has happened, both in terms of the economic movement for the freight and the passenger aspirations for the passenger side, is going to ensure that the capex, the investments, or the infrastructure built up on the railway side is not going to slow down, hopefully in the coming future.
Considering the high capex and modernization plans entailed for railways as a whole, Mr. Chaudhary, brokerages are now estimating a threefold increase in EBITDA and a fivefold jump in PAT over the period of FY23 to 26. Would you concur with that view?
We would not be able to speak about the forward-looking projections, and all we can say is that we've kind of had a very healthy order book built up. We've started executing the wagons as per the requirements. The Vande Bharat production or the setup is going on as per schedule. We are confident of rolling out our first Vande Bharat by June 2025. Which is going to be a very important milestone in our company's history, and then it's going to be built up from there, the capacities. Pune execution has gone on well. The Bangalore production will start on within the next few days. So all the passenger side, which is actually the business that we have been incubating for a while, is now starting to come in and kick in terms of the top line and the bottom line. The freight side is already going as per the plans. So the sector is the tailwind in the sector is so strong that we are actually being supported by that.
But what I want to understand, and it's completely fine, you can skip giving any numbers, but just in terms of a direction, what happens after FY26? Because at some point there will be stagnancy, right?
So that some point is something which is very, very debatable. We believe that the railways has a lot of catch up to do. The 50, 60, 70 years of the country did not see much of railway investments, railway-centric policies. So we've seen let's look at the kind of highways that have come up in this country. Let's look at the investments that has come into the air travel sector. But let's look at what has happened in comparison to that, to the railways. And railways, we know, is the backbone of the country. I mean, a country of 1.4 billion people cannot function without the railways. Our logistics costs is, as a percentage of GDP today, is one of the highest in the world. And we are now we are aspiring, and we will become, and I'm 100% sure we will become, third largest economy of the world. So for all of this, the catch-up that railways has to do for the last so many decades is large. So what will be that point of, let's say, base, the equilibrium to have a normalized growth is something that we will have to see as we go along.
Mr. Chaudhary, on that note, we'll let you go. Thanks so much for making time and speaking with us. But of course, a lot of these solar-related stocks are doing quite well, given that entire push coming in from the new scheme that Prime Minister has announced. Almost 1 crore households are going to get the solar rooftops as well. Let's first quickly go across to my colleague Prakash, who's joining us with what the details of this latest policy announcement is. And then, of course, we'll take the discussion forward. But Prakash, fill us in with the basic details.
Yes, a very significant development coming in as the Prime Minister has announced a new scheme for rooftop solar projects in the country. A new scheme called PM Suryodaya Yojana has been announced by the Prime Minister on the auspicious occasion of consecration of a Ram temple. A very positive development coming in as 1 crore households will get rooftop solar projects under PM Suryodaya Yojana. While making an announcement, Prime Minister has said that this scheme will not only bring down the electricity bill of the consumer, it will also make India self-reliant in the field of energy. However, there is a national rooftop solar scheme which is already underway, where government provides 40% capital subsidy on installation of rooftop solar projects with capacity up to 3 kilowatt. This scheme was already extended by the government till March 2026, but there is a possibility that the government will merge existing scheme with the PM Suryodaya Yojana with additional benefits. Along with that, there is a separate proposal before the government to increase capital subsidy under existing scheme on projects, on rooftop solar projects, especially with higher capacity. However, there is a possibility that the government will enhance allocation of funds for rooftop solar projects in the interim budget.
All right, thanks very much for that. In fact, let's take that discussion forward with Mr. Hitesh Doshi, the Chairman and Managing Director of the Wari Group. Thanks so much for taking time out. I wanted to get in your initial thoughts then on the program that has been announced and what exactly this would potentially mean for the overall sector and how... Oh, we seem to have snapped that feed. We'll just reconnect in a moment. But in the meantime, yes, indeed, a lot of those stocks are a buzz in today's trade. And for now, Anisha, holding out at 21,700.
Yeah, the market is holding on, and this scheme is quite, important because, of course, there was a similar scheme which was at play earlier, but it seems like that now there'll be more push given in terms of the subsidies, etc., and the entire ecosystem stands to benefit. So REC, which is going to be the primary implementer of the scheme, is expecting that there could be a push of almost 40,000 crore coming in through that. But in terms of the overall scheme, there are analysts which are pegging in that overall the incremental contribution from this in terms of the expansion of the capacity in the country for now is going to be a bit limited. Almost 1,000 square feet area for each rooftop brings it to around 45 gigawatt installation. But let's pose that question to Mr. Doshi as he's joining us on the show. Mr. Doshi, hi, if you can hear me now, that's what the first question is. Help us understand the importance of this policy announcement, because we do understand that there was something similar which was in place. What is so differentiating about this new announcement, and how will it help the entire solar rooftop ecosystem?
Good morning, and thank you for inviting me for the call. I think this is a game changer. First of all, if you look the difference between earlier and the scale, we are speaking about 10 million roofs to be covered under this. And number two is government is coming up with the different subsidy plans, the technology, and lot many things together. What we see is that this will help the country overall to generate the more power. It will help the load on the distribution and transmission to reduce over on it. So the power generator himself, who is a producer, he is a consumer also. And such a large demand coming to the entire value chain. This is right from the solar module, inverters, cables, and it's not only the modules. It's a glass, aluminium, and many other components to make the module. So this will be almost, we have to get the detail in terms of the megawatt and execution details. But I think this will be a close minimum 30 gigawatt and maybe the maximum 50 gigawatt, which I can guess today. So such a huge demand will come up across the value chain. This will help the installers. So there will be a huge employment. This will further help to the future maintenance and management. So this is going to be the world record and very good news for everyone, right from the power consumer to the industry.
And, we're waiting more details on what geography that 1 crore households are going to be targeted. But Mr. Doshi, do you think we have that kind of supply capacity? Because it's 1 crore now, I'm sure the scheme is going to be extended to more and more houses eventually.
So the major component required in this will be the solar panels, and India has already reached to the 60 gigawatt of the local manufacturing of the solar panels. And this is apart from the 50 gigawatt of the PLI, which is going to come. So in my opinion, capacity is not going to be the problem, and supply will be more than enough available for this project.
Do the cost dynamics work out for, the entire industry? Because I'm sure as the numbers as well increase, there would be cost subsidization as well.
Yes. I mean, when we look to the rooftop costs, we have to look to the entire value chain, like you are saving completely on the distribution investments, lines, transformers, all other things. There will be a lot of saving on that. And most importantly, with the transmission losses. So when you calculate all this, the payback for the solar is not going to be the much higher. What has been expected, in my opinion, it will be much lower. So it will benefit to the consumer on a big way.
Actually, Mr. Doshi, if you can give us some more color on that. Yes, perhaps the payback is going to be lower, but if you can fill us in terms of an average household, what's the kind of rooftop capacity they can add right now? What does it cost? And again, what could be the payback in that sense?
The rooftop, if you consider now, it starts from 1 or 2 kilowatt. In a city like Mumbai, we have a large terrace on the societies, and this can go up to hundreds of kilowatt. Coming back to the payback, city like Mumbai, where we are paying average 7 or 8 rupees a unit, the payback is less than 1 year. So when you are investing into the solar, even if you consider the 1 year, you get the power free for the almost a lifelong. That's minimum guarantee of the equipment is 25 years. So if you see the guaranteed period also, it is at 24 years. Where the power prices are lower, for example, maybe 5 rupees, there the payback may go up to 2%. But as we have seen in the news, government is coming up with the subsidy plans for this. And probably once we have the details of the subsidy, the exact payback period can be calculated. But today, overall, the solar is a no-brainer, and the paybacks are not longer.
Sure, and if I can ask you, just as an industry doyen, in terms of which are the key solar rooftop players, if you can talk to us about your market share right now in the country, and maybe which are the others that are competing with you, just to get a sense of the ecosystem?
Of course, there are enough entrepreneurs who are doing the rooftop, and there are a lot of installers in the market also. So first we go to the supply chain. All the supply chain is available, then the requirement more than that. When it comes to the installation commissioning, companies like Wari and the government of India also under the skill development are there. A huge trainings are going on for the installations and commissioning. As well at Wari, we have today close to 300 franchises, and every franchises have their installers base, which is between 5 to 50. And these installers pick up the material from our partners, and they go and they install. Larger roofs, Wari does the directly under the group company here, which is a subsidiary again here. So another large name in the industry is definitely Tata's and many more. And if you look to the example of the Gujarat, in Gujarat alone, today there are close to 1,000 plus installers. So developing the installers, developing the service providers does not take more than a 6 to 8 weeks training time, and that's quite easy.
All right, appreciate your time. Thanks for giving us a lot more perspective as to what exactly this means for the sector and for the company as a whole. But let's shift gears from one corporate voice to another. IDFC first, we delve into the earnings fine print. My colleague Ajay in conversation with V. Vaidyanathan, the MD and CEO at IDFC First Bank.
All right, so we are in the thick of earnings season, and IDFC First Bank is the bank in focus in terms of the earnings. We have Mr. Vaidyanathan, who's the MD and CEO of IDFC First Bank, to talk more about the results. Mr. Vaidyanathan, morning. Thank you so much for your time. Hope you are recovering well from your ligament injury. But clearly, the marathon which you have started here at the bank continues as a very regular and steady clip as far as your numbers are concerned. But we'll talk about the numbers reported this time and the issues at hand in the near term a bit before we go about the exciting part. You shared the 5-year growth plan and guidance as well. I want to talk about the OPEX part first. It has shown a bump up. What are the reason for it? And do you think it will have a upward bias in the short to near term, or is just a one-off this quarter?
So this quarter, our OPEX is a little higher than what we're allowed to see. Actually, the festive period is going on, so there was a little more action, marketing activity, dispersal, etc., and dealer DSA payout, etc. So that was a little more than what we expected, and then a little more technology expenses. I think about 70 odd crore, a little more than what we have loved to see.
Mr. Vaidyanathan, we also see there was a bit of an impact from the RBI new norms as well. I want to talk about this, not only this impact, but also AIF exposure, which you have. And RBI seem to be a bit uncomfortable about the unsecured part of the consumer loans. What are your thoughts on these issues?
First of all, we have no exposure to AIF, so to put it on the side. And as far as the RBI's, you could see that it is there. There is a soft guidance that we should be careful. There's a public commentary coming that we should be careful. And our comment is that, yeah, we should be very, very careful. And we have actually, after the risk weights have gone up, we have slightly increased the interest rates on our personal loan portfolio. And we also tightened some credit norms. We want to slow it down a little bit. But otherwise, it is quite risk adjusted and it's quite profitable.
Okay. So even after taking moderate slowdown on the growth and disbursement front, you don't expect a major structural impact on the trajectory and the contribution it makes to your overall book?
No. Like I said, we intend to slow it down a little bit because of so much of signals coming. But otherwise, on our portfolio, performance is really very good. And in fact, I think if you saw the gross NPA numbers of our retail portfolio now, which is the retail portfolio, the rural portfolio, SME portfolio, that is 1.45% now. It was 1.52 last quarter. And our net NPA is now 0.51, which is the same as last quarter. So numbers are very strong and stable. There's no issue there as such.
See, your GNPA as well as net NPA, both of them have actually improved 70 and almost 68 basis point QOQ. I want to understand what's the guidance on the outlook on asset quality. You expect it to be steady?
We definitely expect it to steady. We basically measure it by the input indicators that coming into the NPA. The input indicators are what is our SMA, and before SMA, what is the collection percentage? We publicly report every quarter for all the 3 months of the year. We report a collection percentage is coming at 99.5% for the primary bucket. That's really very strong, and there is no weakness there. And on that basis, we've guided for our future guidance as well. But of course, as the markets, we should be always careful for the future. So we've guided for us, we've factored for a slightly higher credit cost. But otherwise, things are quite normal.
Mr. Vaidyanathan, let's move on to the bright spots in the numbers. This time round, again, we see very strong improvement as far as your CASA is concerned. And this is coming at a time when overall environment is becoming a bit challenging. There's a war for deposits, if I may call it, on ground. How are you managing it, and what's your thoughts on it? It will remain for some time now, the pressure there?
Our credit deposit ratio for the 9 months of this year is only 79.8%, or let's call it 80%, which is quite healthy. For the last quarter, it is more like 65%. So our deposits are coming very strong. Obviously, it's coming more than our loans. So we are holding up quite well there. Our deposits, our CASA ratio is also quite healthy. It's coming along well, and we are not seeing any concern on that front.
Okay. If I could just go back a bit before I come to your guidance, Mr. Vaidyanathan, out of your loan book, the different ingredients of the loan book, what kind of growth versus outlook can you share? Which end of your loan book is growing highest, and where do you see improvement or moderation going forward?
See, except our infrastructure loans, which we are bringing down, already brought down from 22,000 crores to now 2,500 crores, which will hopefully wind itself away. Rest of the portfolio is all behaving well and we are growing. So we like the home loan business, we like loan against property, we like the car loans, we like two-wheelers, we like the SME loans, we like the rural business. So it's like asking me to pick which of your fingers you like, but they're all good. And our own sense is that the next 4 or 5 years, we feel that picture is quite clear, the coast is clear, the business model established. So we are really looking forward for the next few years, and we want to improve our profitability now. That is our main, let me say, agenda left, because we come to ROA of from 0 to 1, we still, a good benchmark will probably be 2. So that's the only work to be done yet.
Yes, I remember we were talking 2 quarters back, Mr. Vaidyanathan, and you did indicate that Ajay, picture abhi baki hai, and the picture played out pretty well after that. But the issue with this kind of a strong performance, that it also elevates expectations in the market. Now that, okay, let's take a stock of how the first term of your guidance has been so far. How do you rate your own progress made? I have the presentation right in front of me, but where would you see part of your guidance is still work in progress, and which part are you happy about that you have achieved?
First of all, you're forgetting. I didn't say picture abhi baki hai. I said picture abhi shuru hui hai.
Shuru hui hai.
Yeah. So basically, what we have got right thus far is that our deposit strategy has played perfectly well. We are getting good quality deposits. The second part which we got right is the culture in the bank. Plain, straightforward, high quality banking, asking our employees to be truly very, very, very customer friendly and bend backward for the customer. We got culture right. We got deposit right. We also got the loan book right. It's been 5 years. We haven't set one foot wrong on lending side, asset quality side. So these things we got right. What we are behind, let me say, a good benchmark are two things. Our cost to income ratio is, let me say, has not yet caught up with our peers. It is coming down, but is still far away from where the peers are. And in terms of return on assets, a good benchmark would be 2. We are at 1.1.
Just to let our viewers know, in the 5 years, the first 5 years of the guidance you had given, your customer deposits have gone up 4.5 times. Almost growth in branches. Everybody is talking about branches within your peers as well. Almost 4.5 times. Almost 2 times, 2x is the growth in loan assets. 5x improvement in CASA. Almost 3 times improvement in your pre-provisioning profits as well. Next 5 years, FY29. You gave a bit of a hint that the sole agenda of the bank would be to improve profitability. Mr. Vaidyanathan, talk to us about the levers you're aiming at pressing and what is the scope of improvement in profitability hence.
See, the levers are easy to understand actually. For the first 5 years, we set up the infrastructure, the capability to originate this kind of deposits. For a bank, deposits is the most important thing, because it's low cost, it's the source of funds. Now that machinery is set. Now we believe that it is good enough for originating about 50,000 crores a year, and therefore, when we look ahead 4 or 5 years from now, there are few things that will come in our favor. We will pay off definitely all the high cost liabilities that would improve our profits. Some businesses like credit cards will become profitable. That should add to our profit meaningfully. 50 years from now, it will be like solidly in profits. Then the operating expenditure of the bank itself should slow down because we got the critical mass. So these are the maybe 3 reasons why our ROE should start improving from here. And we have guided for a picture of what the 5 years should look like in our guidance 2.0.
That's correct. As far as the guidance is concerned, the ROE which you have indicated could be around 17 to 18%, 1.9 to 2% is the ROA target. And just for the benefit of our viewers, it translates to roughly estimated 12 to 13,000 crore as far as the net profit goes, if the ROAs actually move in that direction. Before I let you go, Mr. Vaidyanathan, a quick word on the environment also. We spoke about near-term here and now of your numbers. We spoke about what you're directionally looking at from here on. But I'd like your opinion on the lending environment as well. In the last 2 months, there have been multiple instances where our regulator has spoken about certain sections of the entire credit growth and loan growth in the industry is getting heated. What are your thoughts on that? Companies such as your bank, such as the other, which do very technology-backed SME lending, how are they cushioned now in this environment versus how SME lending used to happen years back?
So, first of all, this is a very important caution, and we are also heeding it. That is one of the reasons, we are also tightening our credit norms. If you notice, our current growth rate of loans is running at 24.5, but for the next 5 years, we are guiding only 20%. Now, we feel 20% should be reasonably very easy to achieve, for the bank. That's what we are putting. So that's how we look at the context. Overall, Indian economy is looking good. People income is rising. Growth rate is growing at 7% plus. Real incomes are increasing. So in that sense, it's good, but better to be careful than sorry.
Okay, so that was about IDFC First Bank, but Persistent System is up around 10% because they reported a beat versus expectation. Mr. Sandeep Kalra, the CEO of the company, is joining us to talk to us about that. Sandeep, before I come to your earnings, talk to me about the overall demand environment and how you think calendar year 24 will pan out with respect to client budgets.
So please keep in mind, in any kind of an economic situation, a weak macro or a bad macro, there are companies that will outperform their peers. So for that, for example, in our case, on one side, we are very closely watching how the budgets are panning out, and the budgets may remain stagnant or may increase by a little bit. But then in a weaker economy, there are revenue pools that are available. So for example, one of the channels that is kicking very well for us is private equity. So when the market is weak, there are many carve-outs that happen from companies that have weaker balance sheets. Newer companies are formed and so on. And that spawns off a new set of work for us. There are newer technologies like AI and generative AI, where people, while they're shrinking their budget, they are still trying to squeeze more from business as usual and put towards more revenue enhancement based on the newer technologies. So while the budgets, we don't expect them to go much higher from where they are, we expect the weakness to continue for another couple of quarters and then green shoots to emerge in different sectors. There are ways and means by which we are addressing our efforts in our client base differently to make sure that we have a healthy growth, weak macro or good macro.
Right. So are you saying that your order win rate has improved? Do you expect the deal momentum to remain sustainable?
Right. So there are two parts to it. One, if you look at our sales and marketing spend is at a heightened level if we compare 9 months of this financial year, to the 9 months of last financial year. And why is it so? So if you look at the deal wins, they are a function of how much deals you bring in and then how much you convert from that into actual win. So if there's a weak macro, you need to bring in more deals so that even if lesser of them convert or they take more longer period of time, you're still having a healthy pipeline. And that's what we have done. So from that perspective, on one side, we have expanded the pipeline. On the other side, we have had good deal wins as a conversion. And look, we don't give forward-looking guidance, but if history is anything, 15 quarters of sequential growth in revenues and stable to increasing profits is what we have delivered.
Yeah, that trajectory has been really stellar when it comes to the time gone by. But Sandeep, the sales and marketing spends that you talked about, right? That's bound to limit your margin expansion. And on one hand, the analysts are expecting that over the course of next 12 to 18 months, there should be a margin expansion to the tune of 100 basis points. Your comment to that?
If you look at the sales and marketing spend, while the sales and marketing spend is at a heightened level compared to the prior, year, we have worked on the utilization. Currently, our utilization is at 81.5%. Even that has scope to improve over a period of time. Now, if you look at our SG&A, as the market stabilize, and as I just said, over the next 2 to 3 quarters, as the demand comes back, our SG&A would also give us the leverage. So we will not have to invest in sales and marketing to the extent that we would have otherwise. we have already invested. That will give us the leverage. And then there is a significant amount of new leadership that we have brought in, capability build that we have done. And so from that perspective, that should give us the leverage to increase the margins from here on as well. And look, to run a good company means on one side, you're delivering to the revenues. On the other side, you're looking at every part of your operation and optimizing it on an ongoing basis. And that's what we are doing.
Right, and given that your client metrics have worsened a bit, both in terms of the top clients as well as the number of the $30 to $20 million clients, what's the outlook?
So if you look at the overall metrics, I wouldn't agree that the client, metrics have, deteriorated. Over a period of time, there are quarters when we see furloughs, and traditionally for us and for every one of our peers in the industry, the Q4 calendar in the US, which is Q3 for Indian financial, is a weak quarter from a furlough perspective. That does have an impact on the client, category mix going here or there. But if you were to look at just one data point, the top 50 customers for Persistent gave us 3.4% quarter-on-quarter growth compared to the 3% for the full company. So from that perspective, even top 20 customers gave us 4.7% quarter-on-quarter growth. So there are enough and more metrics that point to a very healthy, growth, both in revenues. And if you look at our deal wins at $521 million in total contract value, this is the highest we have seen in our company so far.
Yeah, deal wins have been strong, but you did talk about furloughs in Q3. Any indication that furloughs might get extended into Q4? And any early indication how Q4 is likely to pan out?
We don't give forward-looking guidance, so I'll not go there as to what the Q4 will pan out. But if you look at a few things, you asked, number one, furloughs. Significant amount of furloughs for us will have concluded in Q3. And even if small bit, tad bit continues in Q4, that's business as usual. We'll take care of it. Now, as far as the growth is concerned, look, if we are announcing healthy deal wins, that deal wins has to translate into revenue, and I just leave it there. We don't give forward-looking guidance, so I cannot give you any quantitative color on that.
Right. And in terms of, the geographies, Europe has been weak and so has been BFSI. Tell us a little bit about, the key vertical trends, the key geographical trends that you may be witnessing.
If we look at Europe, traditionally, it has not been the strongest hold for us. We are investing in Europe. We hope and expect that over the next few years, we'll make it a position of strength for us. And, even if you look at our management addition, we brought in a senior leader to head Europe as well in the quarter gone by. Now, in terms of industry verticals, we've said it over the past several quarters, healthcare life sciences will lead the growth for us for the next several quarters, followed by technology companies, followed by BFSI. And that is the trend that we are seeing in our order book, and that should pan out for us as well.
All right, good to have you on board. That's the view coming in from the management of Persistent. And take a look at the stock as well. They're going to outperform their peers. They're very confident of that, and is looking that green shoots will be seen in a few quarters. Deal wins as well will remain steady. 6.5% on Persistent. Tell you what, then we'll take a very quick break right here on the show. Don't go anywhere. We'll be right back.